Okay. Thank you, Sydney, and everyone for having me here. My name is Sherwood Neiss. It's great to be here. This is fascinating for me, by the way, to listen to what's going on in this whole ICO blockchain space, because it reminds me of what was going on in our heads when we came to Washington, D.C. with this idea to help startups and small businesses raise money online. Before we came here, we actually took this idea and we talked to lawyers. I'm not a lawyer, by the way, good news. And I got their opinion as to whether or not this is a good idea. And everyone said, you've got to be crazy. There's no way we think this is a good idea to let the average retail investor come into this space without some sort of understanding about what they're getting into. And I think there's a lesson to be taken away from what we did that this whole ICO blockchain industry could probably learn. And so we listened to what they said, which is, there's a fear out there of the unknown of retail investors coming in and investing in startups and small businesses that are really in their own communities, in their backyards. So how do we overcome that fear? And we said, well, why don't we just take what's happening in this current securities laws and figure out what's not working and come up with a framework that we can apply to raising money online that Washington's familiar with. So we weren't showing up in Washington with this idea of, here's something totally crazy. We showed up and we started a dialogue with them saying, this is the way companies raise money. This is the way the securities laws currently allow them to raise money. By the way, they're a little old, they're 80 years old. So we came up with this idea, and this is vetted, and we talked to lawyers, and we talked to a bunch of different people, and we want to get your feedback on it. And we're willing to negotiate and talk about how we can change this. And we built bipartisan support by doing that as we walked the halls of Congress. So we didn't try and come here and shove something down Washington, D.C.'s throat. We came here with a framework, and I think what I'm missing, and I was happy to hear that Vince is working on something like this, is a framework for how this industry can work. Because I think when you explain to people the framework under which this whole transaction will take place, and I understand there's a lot of brilliant people in this room that know how the technology works and how it benefits people. What I'm saying is, what are you selling Washington? When we came here, we didn't sell Washington on the fact that this is access to capital. This was a great way, we thought, for startups and small businesses to raise money. But that's not what Washington was buying. Washington was buying job creation, and that's what we sold them. We sold them, this is a great way for you to promote economic prosperity, create businesses locally, get the local community engaged, and all you have to do is update these security laws. That mindset, I think, is what needs to be brought to the ICO and the blockchain type of industry to help move this conversation forward. And I think if you do that, you're going to be changing it for them, because the benefit to you is you get the blockchain industry up and running, and then all this other great stuff that you can do with the blockchain and ICOs happen as default of it. But what is it that you're selling to Washington that they're buying? Is it AML? Is Washington worried about terrorists getting money? Like, where are their minds? Take where their minds are today. Focus that discussion about what you want to sell them and sell them that. So we sold them that. And then we started this, this entire regulation crowdfunding industry. Now, one of the things that I constantly said to Washington when we came here is, if we get this right, if we get this up and running, not only do we get access to capital, you get jobs, but hey, SEC, guess what you get? For the first time in history, you get transparency into the private capital markets that you've never had before, because there's a digital footprint, as Georgia was talking about, to everything that's happening. I'm an entrepreneur. I raised money for a company that was on the Inc. 500 list 3 years in a row. We did 3 rounds of financing. We raised millions of dollars. The company was actually based here in DC. Everything that I did was behind closed doors. Nobody knew what was going on. The SEC didn't know, the investors knew, I gave them updates, but there was no real transparency on a regular basis. I actually did annual reporting to the investors, which they loved. But now that we have this mandated type of disclosure that takes place when you raise money online, as Georgia was telling you, when you do updates, when you do any amendments, all of this can be recorded. And so we built a database called CClear, which namesake, thank you, Georgia, which stands for Collect, Clean, Aggregate, and Report, because that's what we're doing. We're collecting all the data, we're cleaning it, we're aggregating it, we're reporting on what's happening in the industry. We can do this now because all of these companies are raising money online. Because they're raising money online, we can actually see what are the industries that are getting funded. Where do investors have an appetite for what's going on? We can learn a ton about what's going on with averages. Like if I'm a company and I want to raise money, which industries raise the most capital on average? And so this presentation is meant to sort of quickly dive into all this. I think we can go into more discussion later on. But I just want to give you an overall glimpse of what we can see now that this industry has been about 18 months old. The reporting that I'm going to show you is up through October 31st. We take out all the information from any company that's withdrawn their offering. We only report on companies that are raising money on these portals that are registered with the SEC. And the portals have to be active as well. One of the things that we realized early on is, again, let's not recreate or reinvent the wheel. Let's just take stuff that's out there already that the market is already using and apply that to what we're currently doing. So we classify every single company that's raising money online according to Morningstar's Global Equity Classification. It allows us to actually have a great conversation with Wall Street. Because they can see what's happening in the private capital markets, compare it to what's going on in the public capital markets, and see if there's any trends or what's happening that is of interest to them. And so the other thing that we focus on in this presentation is I realize there's a lot of companies that raise money online, particularly in regulation crowdfunding. I think we're about to hit the exceed the 600 company, but I only really want to cover the companies that were successful. I really want to learn from who's successful, so did they hit their funding target and did they close? And we look at the data from two different points of view. There's the macro level, so what's happening in these sectors, and then there's the detailed level. And so with the macro level, we can see trends about where capital is flowing, and in the detail level, we can do our analysis as where investors have an appetite. So these are some of the key findings that we found. There is actually a match between issuers who are seeking capital and investors that have a risk appetite, particularly with those businesses that are most sensitive to economic shifts. So what does this mean? Well, when we look at the data and we see what's going on with the companies that are getting funded, it means that, wow, lo and behold, as we said, regulation crowdfunding is actually doing what it said, which is filling the funding void, okay? This is not the whole Bitcoin thing where companies are raising hundreds of millions or billions of dollars. These are companies that are raising serious capital that they need to fill this funding void so they can get to the next level, prove what they need to do with, I think someone in the hedge community was saying, show me what you can do with a little bit amount of money and then I'll give you a little more later on to do something else with. There's a match between products that have consumer appeal and crowdfunding. So what this is really how do you turn your customers into investors? And it's unique in the sense that you couldn't do this before. My company that I had before, we flavored medicines for children so they're more compliant. Every time a mother got her son or daughter to take their medicine, the next phone call was to me saying, how do I become an investor in your company? Well, you couldn't because we weren't allowed to raise money from anyone that wasn't an accredited investor. But imagine if I could have turned all those parents into investors, not only would they be out there telling everyone else about the product or service that got their kid to take the medicine, but they would be doing marketing. It would just work in our favor. So what we're seeing in the initial data that's coming out of this is exactly what's happening with regulation crowdfunding. Businesses are going to their customers, they're turning them into their investors, they have a vested interest in the success of the business, and it's leading to a better bottom line for those companies. What you see are these application software, restaurants, alcoholic and non-alcoholic beverage businesses leading in deals and dollars, but there really is a broad use of regulation crowdfunding across all industries. So what does that mean? It means that it's not just one industry that's appealing. Many people, many companies are realizing the benefit of this, and they're using regulation crowdfunding as the initial way to go out and get capital. The macro level data tells us where issuers can raise money, and the micro level data, because it's broken down, there's about 148 individual industries that Morningstar covers. You can imagine we're going to have more traction and more time before we can show any significant trends from that. So I'm going to just move really quickly because I know we have limited time and all that. But if we're looking at where the companies have been successful with this, are they immune to economic shifts? And so Morningstar breaks it down by cyclical, sensitive, and defensive. Cyclical type of industries are those that are impacted by economic shifts. So they expand in good times and they shrink in downturns. Sensitive are industries which ebb and flow with the overall economy, but not severely so. And defensive industries are relatively immune to economic impact. Customers will always need these services. So when you're looking at this tree map here, I think it's really fascinating to see that this cyclical part right up here, companies that are impacted by economic shifts are raising the most money and they have the most offerings. So there's a few things that this says. This says that these are probably companies that your VCs might not invest in because you need to see a little more history or traction that's going on with them. But the crowd clearly says, you know what, I'm a customer there. I might put my money into it, okay? The second one is the industries that ebb and flow. Again, the crowd says, listen, you know, if it's seasonal, I see what's going on with it. I can be an investor in this, and they're putting their money into it too. We're not seeing so much of the defensive side, the companies that you're always going to need. Yet, granted, it's there. We've got companies that are raising, but I think it's fascinating to see that it's the companies that are a little riskier are the ones that are going out there. Now, that might be also because the investors are not willing to put money, the VCs, like I was saying, into these companies quite yet. So that's the macro level. What I tried to do in here is show you, if you break it down by quarter, what it means that's going on. Don't spend too much time looking at Q4 here, other than to let you know that this is 1 month's worth of data. So this is just from October. So we've got November and December still that's going to stack onto this. The cyclical is the blue. So these are the riskiest companies. They're closing the most offerings and raising the most money over time. You can see how it's generally increasing. Sensitive is red. These are those companies that ebb and flow and seem to be picking up interest as well as proceeds. And defenses, this is that one part of the market that I was telling you was immune to economic impact. So they've got steady offerings per quarter and steady funding. There's a broad investor appetite, okay? We've got personal services, entertainment, restaurants, retail. All of these are susceptible to economic shifts. They're leading in deals and dollars, okay? That's the blue area right up here. The technology and business service firms that ebb and flow, they're fast followers in deals and dollars. And then we've got this segment, which is beverage, alcoholic and non-alcoholic. It's fascinating to see the number of breweries, distilleries that are out there that have a massive following. So when you look at these breweries that have Facebook fans or Twitter or LinkedIn followers, they're literally using that social media to turn them into customers, or investors, I should say. The breakaway really is your technology, your personal services. What I like about the personal services, again, these are people like your veterinary, your pet services, your gym, your yoga studios, all of these things that are not your traditional way of getting funding. It turns out to be a great way for you to go out and get capital from the crowd. And we're seeing that the capital is increasing. If you look at technology, they have had the highest percentage increase in deals and dollars over time. But if you look at your personal services, there's most companies out there that are raising capital, and they're raising the most money, as you can see at the bottom over there too. If we want to drill down, again, now into industry groups, we're looking at operational characteristics. So now we take the technology and we break it down into application software and gaming. They lead in deals and dollars, followed again by alcoholic beverages, which is less than half the deals, but almost the same amount of proceeds, which I thought was interesting. And you can see this is spreading out now. This tree is really starting to spread out, but there's broad use of regulation crowdfunding among all industries. Now I just wanted to just sort of summarize, if we were to take what was going on and look at companies that raised in $1 million in proceeds, you'd see that entertainment-related companies had the most. So people that were doing movies or theater-type productions were raising the most in terms of dollars. But those personal services, gaming in the brown, had the most number of deals. So again, it's what business are you in? What industry are you in? If you're in an industry like entertainment or software, you might be able to raise the most money, but one of these other ones, personal, there's a ton of them doing it, raising a little less money. Maybe they don't need as much. The top 17 campaigns, all of these raised over $1 million. This shows you what industries they were in. Recreational vehicles. Start Engine seems to be leading the path when it comes to this recreational vehicle industry. Again, we need to see more of what's going on to see what traction, But you can see these are all companies that have hit that $1 million maximum funding target. It's spread out. It's not focused on one specific industry. Because we collect all this data, we can see averages that are happening. So this chart shows you the average raise by industry. And you can see that these breweries, they're raising the most on average, followed by medical devices and diversified industrials. All of this information is informative to both companies that are going out there to raise capital, to investors that are thinking about investing in these businesses, and it helps shape their investment decision. This chart just shows you the same thing too, which is the number of investors in an industry. So if you are an issuer and you want to go out and raise money from the crowd, this would tell you on average how many investors you would need in order to be successful with your raise. And the last couple ones are valuations. So because we collect all this information, before when I was raising money for my company, I had a conversation about what was the right valuation for my company. Now we've got all this public data that's being collected. So now I can aggregate what's going on within the industries to see what average valuations are. And this helps investors know whether they're paying a good price, overprice, or underprice for the company that they're going to invest in. And again, because this is all reported, we can see success rates. So good news, if you're in the alcoholic beverage industry, you've got a 79% chance of getting funded. Any travel and leisure, it's 75%. Now, the good news about regulation crowdfunding is the companies on average have over a 50% success rate. Now, Georgia brought up a good point that some of them are putting unrealistically low targets in there, which is true, but the average raise right now is about $300,000. So these companies are getting what we think is critical capital. We're not trying to solve problems for big businesses. We're trying to solve problems for small companies that create substantial economic output for our economy. And I think this is doing that. And now with this data, you can see what's sort of happening in terms of the success rate. So companies that want to go out and raise that money can figure out how to do that. And with that, I'm going to jump back over here.